Hi, it's John Kelly. In this module, we are going to discuss the evaluation of errors. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. Now, the section is pretty complete and really doesn't require a lot of discussion. It's sort of self-explanatory, but errors do require evaluation, and so let's just quickly go through this. First thing, do errors found mean that the plan needs to be changed? And we should always be evaluating that. If we're finding stuff that's totally unexpected, we need to consider whether we need to redo our audit plan in some way. We would ask management to correct all errors found, and of course it's best if everything is corrected. We would evaluate if the errors found were material, and hopefully we've corrected them all, so that's easy. And we would consider carry forward error. In other words, if there were errors in last year's financial statements that affect this year's opening balances, we would need to consider the effect on this year's financial statements. And that's just another reason we like to adjust everything, so we don't have to do that. Errors have to be in the representation letter if they are not adjusted, another reason to adjust everything. And I'll tell you an example of a trucking company where it was an audit that we took over, and materiality was $100,000 in the prior year. And when we were looking in the prior auditor's working paper, there was a working paper that said, well, this is being accounted for as an operating lease. It's really a capital lease. The effect is $50,000, and it's not material. And then there was another working paper, same conclusion, and another working paper. And there were in all 50 working papers where they individually concluded that the error was $50,000 and not material. So it was $2.5 million worth of errors that they dismissed, error by error by error, compared to a materiality of $100,000, reviewed by the manager and the partner. That's preparatory to talking about trivial errors and dismissing errors as trivial throughout the working paper as you go. And you can do it one of two ways. You can either dismiss errors as trivial as you go and document a level of triviality, or you can wait till the end of the audit and then decide that certain areas are trivial. You're not going to bother management with them. They're too small. They've maybe already been corrected, and they're just not worth talking about. So at the end, you should document it. So you can document it at the beginning or the end. I think there's also a level I will call sub-trivial. Petty cash is out by $15 and it's been adjusted. The client found out about it, fixed it. So it's been fixed, but in the following year, and it's $15. I think we can probably afford to dismiss those as sub-trivial throughout the file. So two ways to do it: accumulate everything and then decide whether or not to bother the audit committee with certain items and dismiss them as trivial, or you can set a level for dismissal throughout the file. My preference is the first way: accumulate everything and then have senior personnel at the end of the audit decide what is trivial and you're just not going to bother the client and the audit committee with. So what do we have to document in section 450? Well, as we're evaluating errors, we document the level of triviality. And you can do that either at the beginning or the end, though the standard is talking about this at the evaluation stage, so presumably the standard is talking about you doing it at the end, not the beginning. You have to document errors accumulated and if adjusted, and hopefully they are, and every firm has some form of unadjusted error summary where they adjust errors, and a conclusion, and that would also be on the unadjusted summary. And my favorite conclusion is everything's been adjusted. So, thanks for listening.